Hello and welcome to the Bulletin with UBS on Monocle Radio. Each week, the sharpest minds and freshest thinkers in finance take you beyond the numbers and hype, right to the heart of the big issues of the day. This week on the programme, we are catching up and looking back on what has been an unusually dynamic news cycle, even in the context of recent volatile times. From trade and tariffs to inflation via geopolitical flashpoints, there was plenty to try and keep up with and to try and make sense of in the past few days. So, how to best retain perspective and make sense of such uncertain times? Well, let's start by taking a step or two back. We begin with last Wednesday's news that came from the India-Pakistan borders, from Germany's Bundestag, and on the ever-thorny issue of global trade. Here's this programme's regular chronicler, UBS Global Wealth Management Chief Economist Paul Donovan, with his reaction to the day that was.
India has conducted military strikes against Pakistan overnight, and Pakistan's defence minister has pledged to retaliate. The move to military action had been anticipated, and investors appear to be expecting the situation to remain relatively contained. The extent of the Pakistani response will be the next market focus. The potential for global disruption from Indo-Pakistan tensions does seem to be relatively limited, particularly in the context of a long history of disputes between the two countries. Germany has a new chancellor after a slight misstep in the Bundestag. The failure of Chancellor Merz to win the chancellery on the first vote is unprecedented, but it's worth remembering that secret ballots are not the norm in the Bundestag. If members of the government coalition wanted to protest without personal repercussions, this was the moment to do so. The second vote saw Merz elected, and votes on policy will not allow the same opportunities for anonymised dissent. While the failure of Merz to win the first round of the election is evidence of some dissent, certainly, it would be unwise to extrapolate from that into questions about policy effectiveness in the future. With German politics presumably now back on track, trade seems once again set to dominate the headlines. Yesterday, US President Trump seemed to be suggesting that the United States would dictate terms to foreign countries for access to US markets. This appears to be a return to the mistaken belief that tariffs are paid by foreign suppliers, when in fact they are paid by domestic buyers. Trump's reluctance to identify forthcoming trade deals was also rather contradicting the narrative of countries rushing to do trade deals. However, markets have been cheered by the suggestion that US Treasury Secretary Bessent will be talking about de-escalating the trade conflict with Chinese officials this weekend. It is very unlikely that there'll be a deal at this stage. Bessent is not necessarily blinking at China, but is possibly winking at them. However, China, and indeed other countries negotiating with the United States, have a strong incentive to wait until the economic damage of the US trade taxes becomes more obvious within the US economy. With all of this as a backdrop, the US Federal Reserve meets to decide on interest rates. 94 out of 94 surveyed economists expect no change, and so there can be no change. That many economists in agreement could not possibly be wrong. And if they are wrong, then there's something seriously amiss with the Fed's communications. Of course, it is the press conference and the general tone of the meeting that is of most interest to investors. Tariffs, damage to economic growth, and the increase in inflation, including second-round inflation effects, are still sufficiently uncertain that investors are craving guidance from policymakers. That the Federal Reserve is likely to be just as in the dark as anyone else does not stop there being an obsessive fixation with what Fed Chair Powell says today.
The very next day, Thursday 8th, saw Paul reacting next to Fed Chair Jay Powell's remarks on the topic of uncertainty. Here's Paul's take.
US Federal Reserve Chair Powell did the best that they could in the circumstances. They noted that uncertainty had risen, which is something of a statement of the obvious. They noted that there was a greater risk of higher inflation and higher unemployment, which is also something of a statement of the obvious. Powell reiterated that the current policy stance was appropriate for now, and doing nothing seems to be the right approach amidst the uncertainties swirling around policy, corporate reactions to policy, and to the uncertainty, and whether the consumer is going to crack. The problem with this approach is that it stresses data dependency. The Fed reacts to data, it does not preempt data in this cycle. If the Fed is reacting, it is likely to be too late with policy moves, up or down, because policy operates with a lag. And if the Fed is data dependent, it's putting more emphasis on individual data points that have experienced declining quality for years and which are likely to become even less reliable as erratic policy and structural change conspire against statisticians. It's hard to see what else can be done, but there has to be a higher risk of policy error emerging today. Meanwhile, US President Trump has promised an announcement on trade with a big, highly respected country. Like many economists, I'm hoping for the penguins of Heard and McDonnell Islands getting the justice that they deserve. For financial markets, aside from the size of the trading partner, there are only two things that matter. How much does Trump retreat on tariffs, and how quickly does Trump retreat on tariffs? Vague promises to talk about significant cuts in taxes are not really helpful to financial markets. The point is that the economic damage to the United States has already been done, less by the direct effects of the tariffs and more by the uncertainty weighing on corporate decision-making. The shorter the period of that uncertainty, the less the additional economic damage is likely to be. There are reports that the country concerned is the United Kingdom, which would make some sense. If you look at the UK trade data in a certain way, it's possible to claim that the UK doesn't run a mercantile trade surplus with the United States, and so removing the tariffs would seem to follow the US administration's logic. Any trade deal with the UK is unlikely to affect the Bank of England's decision today. The Bank of England is expected to cut rates by 1/4 point. Disinflationary forces in the global economy argue for rate cuts in the UK. The bank does not want to be tightening real interest rates anytime soon. The UK has not indulged in retaliatory tariffs against the United States, so a trade deal is unlikely to change domestic inflation pressures very much, and indeed a full trade deal as such remains relatively unlikely at this stage. Sweden's Riksbank is not seen cutting rates any further. In contrast, Sweden's headline interest rate is already only half that of the UK. The data calendar is relatively quiet. There's first quarter productivity and first quarter unit labour cost data from the States, but this represents data from the before times, which limits its usefulness to understanding the current economic and financial market landscape. The data is always subject to a lot of revision. For the moment, the risks of inflation are not coming from higher labour costs in the States. Instead, it's the sales tax aspect of tariffs, coupled with risks of profit margin expansion, that are likely to concern the Federal Reserve.
Well, and perhaps unsurprisingly, Paul was right on both counts, of course, and that very day we did hear news of a Bank of England rate cut and that Anglo-US trade framework. Whilst that was preceded by substantial media spin, did the transatlantic deal ultimately reveal, rather minimal substance? Here's Paul again.
This is a framework without too much detail. It leaves US consumers worse off than they were at the start of the year, but better off than they were a week ago. It leaves global trade more disrupted than it was at the start of the year, but less disrupted than it was a week ago. A couple of UK sectors get lower taxes, and there may be slightly easier import conditions for a couple of US sectors. The UK has not indulged so wholeheartedly in consumer boycotts of US product as have some other countries, but that remains a risk that no framework can control. The relatively disinterested response of financial markets seems entirely appropriate. The Bank of England's rate cut was far more important to the UK's economic outlook than anything that came from the framework. What really mattered from yesterday's media op was not the framework, but the comments of US President Trump. Trump signalled that 10% universal taxes on US consumers of imports were going to stay. There is a precedent. US President Nixon did this in 1971, but it lasted only a matter of months. If the rule of law still applies in the United States, the legality of this may be challenged by the courts, but Trump's determination to tax is firm. Trump's remarks also signalled a belief that imports, any imports, are a negative for the United States. This rather ignores the fact that imports can and obviously do raise living standards. If bananas and Barbies are deemed bad and were to be banned, US living standards would fall. This approach rather sets the scene for other trade frameworks and arrangements, and if this is truly what Trump believes, then there is no way that the administration's trade policy can do anything other than weaken US consumers' standard of living. The data calendar today is overwhelmed with central bank speakers. Bank of England Governor Bailey and Chief Economist Pill will no doubt elaborate further on the UK rate cut yesterday, although with a split monetary policy committee and Pill a dissent at that, it's hard to know what they can say that will offer conviction of outlook to the financial markets. The Federal Reserve releases its speakers from the blackout period around the FOMC meeting, and this allows for more commentary about how uncertain everything is. It would be unusual for the ECB to be the voice of certainty in central bank policy making, but at least for now, that appears to be what its speakers may be offering. April trade data from China is due at some point in the near future. This is expected to show a sharp slowdown in export growth. Remember, of course, that China will still be selling more or less as usual to other economies, and the avoidance of US trade taxes that takes place via rerouting supply chains may also have ramped up somewhat. A negative export growth figure would be unusual. It's not absolutely impossible.
Thanks to Paul Donovan, as ever, for his daily chronicles. Always a must-listen, especially in the current news cycle. Well, next up, let's get the Monocle house view on that same US-UK trade and tariffs deal. Was it a case of the special relationship strikes back, or much ado about not a great deal, really? Here's Monocle's contributing editor and host of Monocle Radio's award-winning show, The Foreign Desk, Andrew Muller, with his take.
To the extent that US President Donald Trump's decision to launch a tariff war with the world made any sense, and the consensus among economists is that it did not, it was as a massive standover to bully the world's nations into seeking individual arrangements on terms more favourable to America. Certainly this was what Trump insinuated, repeatedly and coarsely boasting of grovelling entreaties from other countries, and at one point claiming to have struck 200 trade deals. This would have been a remarkable accomplishment, given that the United Nations recognises a mere 195 countries, though perhaps, who knows, etc., Trump believed himself to be negotiating furiously with Ruritania, Fredonia, Lilliput, Legoland and the Duchy of Grand Fenwick. We do now know that at least one of Trump's deals has been done with the United Kingdom. Trump fanfared the agreement as full and comprehensive and big and exciting, though such claims do need to be adjusted for Trump's lifelong tendency towards the oversell. The agreement may prove not much more than another iteration of a recurring motif of Trump's life in politics. Create problem, cease creating problem, claim credit as a problem solver. For this is not really a trade deal, at least certainly not a full and comprehensive trade deal. It is a reduction for some items of the 10% tariff Trump slapped on most British imports on Liberation Day, and a scaling back or elimination of the 25% tariffs imposed on British car and steel manufacturers. Possibly grasping for a British brand of which Americans will have heard, US Secretary of Commerce Howard Lutnick beamed that Rolls-Royce aeroplane engines will now be tariff-free. Somewhat ominously, Trump, who has a formidable record for changing his mind and or abnegating agreements or just losing interest, stressed that the final details of the deal are as yet unwritten. It is arguable, however, that the optics are somewhat significant for the UK. Trump could have chosen any country and any leader to be the first recipient of his munificent generosity and abundant reasonableness. President Xi Jinping of China, Prime Minister Shigeru Ishiba of Japan, the chief penguin of the Heard and McDonald Islands, still languishing beneath a 10% tariff. That Trump chose the UK is, at the very least, a solid diplomatic result, a reinforcement of the UK's cherished idea that its relationship with the US is the special one. For UK Prime Minister Sir Keir Starmer, it is the second big trade-related deal in a week after an agreement was concluded with India. Tariffs on certain goods were lowered in both directions. It is excellent news for Indian enthusiasts of Scotch whisky and British gin, and British wearers of Indian textiles, and hopefully for the companies which supply both. The British government's line is that the deal will eventually increase the UK's GDP by £4.8 billion. Whether this proves accurate or not, it does seem mildly preposterous that India and the UK, respectively Earth's fifth and sixth biggest economies, with deep historical, cultural and familial ties, were doing such a small amount of business. India presently accounts for less than 2% of the UK's exports and imports. There is an argument that the UK-India deal can be added to Donald Trump's list of inadvertent triumphs, along with his recent crucial contributions to getting the Liberal Party re-elected in Canada and the Labour Party in Australia. The UK-India deal had been sputtering for 3 years. The UK and India would not be the only two countries who have recently been figuring out ways to help each other compensate for America's possible retreat into protectionist autarky. Starmer is also looking forward to signing a new strategic partnership with the EU in London on May 19th, including commitments on defence and trade. The diplomatic narrowing of an English Channel widened by Brexit has been another unintended consequence of Trump's caprices. For Monocle Radio, I'm Andrew Mullett.
Thanks, Andrew. And that brings us to the end of this edition of the Bulletin with UBS here on Monocle Radio. Do be sure to subscribe at monocle.com to get your copy of the magazine every month and to ensure that you have our daily Monocle Minute newsletter fresh in your inbox every day of the week. And be sure to discover more resources and to find out how UBS can help you at ubs.com. This is the Bulletin with UBS on Monocle Radio. I'm Tom Edwards. Thanks for listening.